Okay. All right. So let's talk about Chapter 1 first. So the way that we attack this class probably to you feels a little bit odd, but let me just share the logic with you. When we are starting in Chapter 1, what we start with in Chapter 1 is the end result of what we're trying to get to, which is the external financial statements. Okay? So what happens is in Chapter 1, we learn all the different financial statements, what the formulas are, all that kind of good stuff and everything. And then in Chapter 2, we back up all the way to the very beginning, and we start from, we had a transaction that happened today. How do we record that? What do we do with it? What accounts are affected and all that kind of good stuff. So just be aware that Chapters 1 and 2, it's going to feel a little bit odd because, again, we're starting with the end. And then Chapter 2, we're going to back all the way up to the beginning and start analyzing transactions and figuring out how we actually record them. Okay? So, again, Chapter 1 is a lot about vocabulary because we're going to learn context of lots of different things here. So the various organizational forms, all right? There are multiple organizational forms to a business. You probably don't even see this or even perceive it when you are out and about and interacting with different companies and stuff. Now, the one that might be the most obvious is if you have a sole proprietor. Okay, so a sole proprietorship, sole just means one, right? Proprietor means owner. So one owner of that business is the only person that does anything. Now, one of the things to note about a sole proprietorship is there is no legal distinction between the person and the business. So what that means is that if that person, let's say that they are a plumber and they have a plumbing business and they go out to somebody's house and they do some plumbing work at somebody's house and they mess something up, and then suddenly the next day those people have a flooded home. Guess what? That person is legally responsible for that loss, because in a sole proprietorship instance there is no legal distinction. So literally, if the folks who had the loss where their home got flooded, they can sue the person directly, and whatever it takes to get them whole is what they're going to sue for. Okay? So that's one of the big downsides to a sole proprietorship, is there's no legal distinction and everything is personally responsible for the owner. Okay? Then you have a partnership. So a partnership just means that there's more than one person, well, two or more people. The other big thing is that, again, with a partnership, you've still got this legal problem. And not only do you have this legal problem, but each individual partner is 100% liable for any losses that the company may have, which means that, let's say that we go into business with one other person, and that person is doing something illegal or inappropriate or unethical or whatever and causes the company to have a loss. But they don't have anything. They have squandered all their money. They don't have anything to make the person with the loss whole. Guess who they're coming after? Us. Right? Because if we have a home, a house, cars, whatever it might be, even though the other person caused the loss, we're going to be held 100% responsible. So when you're talking about a partnership, that's like a marriage. Okay? All right? It is not 50-50. Okay? It's 100 for everybody. So even if there's two people in there, you're not going to be 50% responsible for the loss. You're going to be 100% responsible for the loss, because if your partner can't cover it, they're coming after you. So it is not a 50-50. It's 100-100. Okay? All right? Now, a corporation fixes a lot of that. So a corporation would be a company like a Walmart, right? we actually buy stock in Walmart. And at that point, the only liability that we have that could be a loss if Walmart did something and somebody sued, the only organization that's going to be affected is Walmart. Now, in essence, we could, let's say, completely catastrophic problem, which would never happen, but the most that we could lose is whatever we paid for the stock. If the company just completely dissolved and went out of business, the most we can lose is what we've got in the stock. Okay? But there's none of this, legal issue of coming after us if we own stock in a corporation. Okay? So here's just a little pie chart showing you sort of the numbers of different organizations. So notice right here, 72% of organizations are in the form of a sole proprietorship. So there are a lot of people out there. That's the reason why the Small Business Administration is such a huge lobbying organization. Okay? All right. The accounting system. Let's just get the whole thing up here. All right. So where we are going to live in this class is over here on the left-hand side. We are trying to determine the effect of transactions on external financial statements, and that's where we're going to live. In ACC121, we live on the right-hand side of this chart because now we're looking at managerial type information to figure out how do we manage our business better versus in this one, we're looking to produce external financial statements to send to the bank, to send to a company that we want to do business with. Maybe we want to buy things from them, but they need to know what kind of financial situation we're in to know how much credit to allow us access to. All right? So, purpose, structure, and content of the 4 basic financial statements. All right, so before I go into this one, here's what I want you to do. Pull out a sheet of paper or open up a document, whatever it might be, because I'm going to, and I want you to write this information down on here because I'm going to kind of help you build, call it a cheat sheet that you can work from, because the more times you use this cheat sheet and you reference it and everything, you'll eventually not need it. But these are kind of the big things that you have got to get out of each one of the chapters. And make sure that this is a sheet that you don't put anything else on. Make sure that it's like you're only going to leave it for those things where I'm like, okay, pull out your cheat sheet and write this down. So here's where I'm going to lose all you creative folks. Okay, and I'll tell you why. The financial statements have to be prepared in a very specific order. There's no shortcut, and you can't do them out of order. So all of you folks that are like, oh yeah, I just want to do it my way, there is no doing it your way. It's all going to be our way. Welcome to accounting. All right, so we've got 4 financial statements. All right, now the first equation here of assets equal liabilities plus stockholders' equity, don't write that down yet. This is the formula for the 3rd financial statement, okay? So leave you some space above this because we're going to have 2 other formulas that we're going to work on. So leave you some space for 2 other formulas because this is the 3rd financial statement, okay? The equation for the balance sheet, that's what the financial statement is called, the balance sheet, is assets equal liabilities plus stockholders' equity. I'm going to give you a minute to write that down. All right. Now, if you like acronyms or whatever it might be, watch how this happens because this gives you an acronym. ALLO. So instead of calling it stockholders' equity, I'm just simply calling it owner's equity, which are really interchangeable concepts there. Okay? So if you like a good acronym, there you go. Now, here's the thing. You know how this equation works. I'm going to prove it to you. So if you have a house that's worth $100,000 and you owe $80,000 on this house, how much equity do you have in the house? $20,000. You got an asset of $100,000. You've got a liability of $80,000, which means you have equity of $20,000. All right? Now, that's one asset, okay? The big difference is in accounting, we're going to deal with possibly in real world, I mean, there could be hundreds of thousands of assets that we are expressing in that equation, okay? But we have to group them together, okay? So there is the first financial statement. It's, well, I say the first one. The first equation, but the third financial statement, all right? Now, a couple of things to note here is what we call the separate entity assumption. Okay, so that means that, for instance, Walmart has a transaction, it's occurred, whether they took out a loan, whatever it might be, but it's only going to affect their financial statements. It's not going to affect ours. And if we take out a loan or we do something, it's not going to affect Walmart's financial statements, even if we own stock in them. Okay, so this separate entity assumption is that the business transactions are separate and exclude the personal transactions of the owners. That's all it means. Okay? All right, now, let me also give you a tip here. Don't worry about writing down what's on the screen. You have access to this. So my suggestion is if you want to make some notes, make some notes. You in the back probably can't see that, but that's slide 1-8. Okay, so try to make a note of what the slide is, whatever that might be, and then maybe make a note of maybe the story that I tell or something. I'm going to show you another way that you can actually print these. So when you open up these PowerPoint slides, there is a way that you can print them where you have all the information, all the slides down the left-hand side of the page, and then you've got places to take notes on the right. Because here's the big thing. In accounting class, I think when you're going to learn the most is when you are engaged with what we're talking about, not trying to grab every bit of information that's on the slide. Okay? So don't worry about getting what's on the slide. Let's just stay with me on what we're talking about. So, out of those three things, let's talk about what is an asset, okay? Now, they get a nice fancy explanation up here, but it's just stuff that has value, okay? That's all it's really saying here, all right? And some examples are things like cash, whether it be in currency in the pocket or in the bank. Possibly equipment. So try to start thinking in terms of a business. Equipment would be something like, let's say that we're a construction contractor. Equipment might be something like a backhoe or some kind of, heavy piece of equipment. Software, right? Software has value, and I'm talking about not online software, because we have to deal with that differently, but I'm talking about if we actually downloaded the Office suite onto a actual computer. Okay, I'm not talking about the cloud access. Okay, supplies. Supplies are things that we're going to use in the process of earning revenues for our organization, but it's not what we do. So it's things like, I'm going to use the example in the book. I don't really like it. We'll address something better in the future, but they constantly refer to supplies as things like copy paper, right? We put copy paper into the copy machine. We put toner into the copy machine. We use pens, pencils, things like that. And we're constantly using up those pens, using up those pencils. We're using up that copy paper, that toner, and everything else, but that's not what we do. That's not our job. That's not the core of our business, is not running a copy machine, right? But we're consuming these things to allow us to earn revenues. And then we got things like buildings, right? We got a building. We've got overhead projectors. We've got computers. We've got tables, chairs, right? Things like that. So assets, just things that retain value and are used over time. All right. Then we've got things like liabilities. Now, let me say one last comment about assets. Assets is typically the most, I don't want to scare you, complicated side of the balance sheet, just because we've got so many different kinds, okay? But when we switch over to liabilities, liabilities are pretty straightforward, okay? A note payable would be something like, we borrowed money to buy a vehicle. We borrowed money to buy a building, okay? That is a document, formal document from the bank, whoever we borrowed from. There's usually monthly payments involved, when they're due, if they're not paid on the correct date, when are penalties kicking in, that kind of thing, okay? So a note payable is something that we're actually borrowing from the bank, okay? Versus an accounts payable. An accounts payable would be something more like this. Now, in my feeble mind, it's like the picture that comes to my mind every single time I talk about this is, try to imagine one of those old Western movies. I hope you've seen one where you've got the little town sitting out there in you know, wherever it might be, and people come in and out of the little country store there, and they get something, pick up a few items and everything, and they tell the storekeeper to put it on their tab, okay? That's the kind of thing that we're talking about here when we're talking about accounts payable. Now, in today's more modern environment, it's more like we go to Office Depot and buy pens, paper, pencils, whatever it might be, a new copier, whatever, and we swipe our credit card and effectively put it on a tab somewhere. It just doesn't happen to be at Office Depot. It just happens to be at Visa or MasterCard. Okay. Now, typically in accounts payable, you're talking about a payoff time period of somewhere between 30 and 90 days. Okay. Anything beyond about 90 days, and that's considered to be way overdue. Okay. All right. Then you have something like salaries and wages payable. Well, salaries and wages payable just means everybody showed up for work, but payday hasn't happened yet. Okay. So how much salaries and wages payable are going to say is going to reflect how much we owe our employees and how much that is and when we're going to pay them. All right. Then you've got taxes payable, right? Now, taxes payable, we're talking about federal, state, you know, county, whatever it might be, but some kind of tax that is going to be payable. We'll get into that in a later chapter. Okay. So liabilities, it's what we owe people or other organizations. And then when we're over here under stockholders' equity, we got two things that we're going to stay on in stockholders' equity. Now, if you decide that accounting is your thing and you go on to take intermediate and advanced accounting, it'll be more than two things, okay? But in here, it's just going to be two, all right? So one, we've got common stock. Now, in here, common stock is basically going to be how much stock did we issue? So if we issue $10,000 worth of stock, we've got common stock of $10,000. Okay? And then we've got retained earnings. Now we're going to get into retained earnings more in chapter 4. I want to hold off on that because I don't want to confuse anybody just yet, but we'll get there. So stand by. That's chapter 4. All right? So here's the first financial statement. So on your sheet, now we're talking about the first formula that we need to deal with. And the first formula is revenues minus expenses equals net income. Revenues minus expenses equals net income. And that is called the income statement. Okay, so now revenues are just simply those amounts that we have earned by either providing the service or providing the product to our customers. Okay, so it's all about earning it. Okay, again, they give you all kinds of other information here. Let's see, what else? Nope, we basically covered that. All right, so we're selling to the customer, whether it be our time or whether it be a product, okay? Then we talk about expenses. Expenses are those things that are incurred that allow us to earn those revenues, okay? So it could be something along the lines of, let's say that I was like an independent educator and I was renting this space to actually have this class. So the rent that I would pay on this space would be part of the expenses that I would need to earn revenues from you to teach this class. You with me? An accountant, a doctor, an attorney, right? They're selling their time to their customers. So they figure out how much time they've got into it, times X number of dollars per hour, and that's what is going to be revenue. But they might have to have a computer, file cabinets. They might have to have employees. They might have travel expenses, whatever it might be that allows us to earn those revenues. Now, other things that they've noted here, advertising, right? So we've got to advertise to get the message out to the folks to buy our product or time. We've got insurance. So we'll get into insurance in a little bit later chapter, but basically, right, if we have a vehicle, we have to have it insured. If we have a building or a space, we have to have some kind of liability insurance, property insurance, that kind of things. Utilities, right? We turned on the air conditioners running, the heat's running, we turned on our computers, we flushed the toilet, all those kinds of things are our utilities. And then we talk about office supplies. So again, that whole concept of pens, pencils, papers, ink, toner. All right, how we doing? Okay, so there is our income statement. All right. Okay, now, in the second formula, actually, let's see. I was thinking that they gave it to you. Okay, in the second formula, your second formula is going to be the retained earnings statement. Okay? All right, so the formula for the retained earnings statement, it is a cumulative formula. All right, so we're dealing with it on an ongoing timeline here. So we're going to start with beginning retained earnings. We are then going to add the net income that we just calculated back here. We're then going to subtract dividends to get to ending retained earnings. Okay, now, just to give you a tip here, learn to abbreviate. Abbreviating helps. So I usually start with like beginning, owner's equity, or retained earnings, whichever one you want to do there. Add net income, right? Subtract dividends to get to ending retained earnings, right? Something like that. Okay? Now that gives you context for what we're getting ready to talk about with dividends, okay? Dividends are simply distributions of the company's earnings to stockholders, okay? So think of dividends as you issued stock, I bought your stock, and remember, so for me, it's an investment when I buy your stock, right? And when I buy stock in your company, there's basically two ways that I expect to get a return, okay? One is the price of my stock goes up, and two, you're going to pay me dividends, okay? Or hopefully pay me dividends, all right? So here's the thing. When we're paying dividends, you have to realize that dividends, just go with it for the moment, function like expenses, but they do not hit the income statement. You see how that's working? So we start with beginning retained earnings, we add net income, right, which we already calculated, then we subtract dividends to get to ending retained earnings, okay? We're going to learn that one formula is a lot of what's happening in chapter 4, okay? So don't get too messed up if that's throwing you off a little bit for the moment, okay? All right, so all of that functions within this retained earnings. So we calculate net income, that flows through to the retained earnings statement, then we actually subtract out dividends to get to the ending retained earnings. That's kind of how that slide is being read, okay? But it's important to understand they are not expenses and they do not show up on the income statement, all right? So there's your 4 financial statements. You got your income statement. That is, what's the formula? Good. Revenues minus expenses equals net income. All right, that net income flows through to the statement of retained earnings. Formula for the statement of retained earnings is beginning retained earnings plus the net income minus dividends equals ending retained earnings. That ending retained earnings that we just calculated now flows through to the balance sheet, to the equity section of the balance sheet, okay? And the formula for the balance sheet is, what is it? Perfect. Assets equal liabilities plus owner's equity. How are we doing? Okay? So these 3 financial statements have to be prepared in that order, okay? Then, off to the side of that balance sheet, we're going to do a statement of cash flows. Now, the statement of cash flows is we're proving the cash balance that is we are showing on the balance sheet. So if it says that $10,000 is sitting out there on the cash side of our balance sheet under assets, if we've got $10,000 in cash, basically this statement of cash flows is going to prove how we got to $10,000 of cash. Okay? So, we're going to look at that one here in just a second. All right. So, income statement. So, in the book, so again, this is part of the reason why it's really important for you to read the book, watch the, do the slides and everything else, because all these slides, all the lectures and everything else, we're dealing with the same story of the same company in the chapters. So if you had already read and you had already done your SMART book, right, then you would be looking at this thinking, yeah, I've seen that before. And you get in another opportunity to understand what's going on, okay? So here's your income statement. Now notice this one, a couple of things to note here is in every financial statement, you're going to have 3 things at the top. You're going to have the name of the company, the title of that financial statement, and then the date. Now, notice that the date on this one says 4 month ended September 30th, which means that all of this information that is shown right here covers just September from September 1st. You with me? Now, it could say, if it said for the quarter ended September 30th, that means that all this information would have covered. Don't say June. How about July 1, right? July, August, and September, right? Okay. So that would be quarter end. If it said year end ended September 30th, it would have, the first date would have been October 1st of 2023 to September 30th of 2024. It can be, but that wouldn't be a external financial statement. We can do all kinds of things internally, but typically an external set of financial statements is going to be always the last day of the month. Okay? How we doing? So, that's the title and everything up there at the top. Okay? You'll see that as a commonality on all of them. All right? Then in this one, because it's an income statement, we get a heading of revenues minus expenses equals net income, right? So then in this particular case, we've got Noodle Cake Studios. They have sales revenue and service revenue. Now, when you see the word sales revenue, that means we are selling product. When you see service revenue, that means we are selling time. And we want to track those individually so that we know which one is bringing in how much revenue, okay? Then we just simply total the revenues and give it a title. Notice it's one line above, one line below. That indicates a subtotal for revenues. Then now, what order are these two in? Good. Largest to smallest, highest to lowest, right? Okay, now shift down here to expenses. So now we give it a title, expenses are coming. We list all the expenses. What order are the expenses in? Good. Highest to lowest, except for income tax, because income tax always comes at the bottom. Okay? Then we get a subtotal for the expenses, and simply 12,000 minus 10,000 equals 2,000 for our income statement. Because when we get to a multi-step income statement, and that's going to be chapter 6, that will make more sense to you. It's just always that last thing, because one, I guess on some level, it's like that's the last thing that we have to calculate at the end of every month is taxes. So if we have income, we know we're going to have income taxes. If we have a loss, we know we're not going to have any income taxes. So tax is the last thing we have to do at the end of every month. All right, how are we doing? Okay, all right, let's take a look at, one other thing that I forgot to mention is, notice on this set of financial statements, we have a dollar sign at the top, a dollar sign at the bottom. So you're looking for the currency indicator. So if we were in a different country, right, it could be something different. All right, now notice what happened. We pulled through, now we're dealing with a statement of retained earnings, and we pulled through that $2,000 in net income, right? Now, let's start back up at the top. Noodle Cake Studios, name of the company, title of the financial statement, and again, the date. In this one, it is 4-month ended again, because that actually makes sense because this $2,000 covers a time frame, right? It covered that whole entire month. All right, so we subtract out the dividends, and now we've got retained earnings of $1,000. Now, let's stop and think about this one for just 1 second. Remember, this is a cumulative financial statement. Okay, it rolls through from year to year to year to year to year to year. Okay, so if we had the exact same thing happen next month, at the end of next month, when we do our retained earnings statement, we would start with $1,000, add $2,000 in net income, pay out $1,000 in dividends, which would get us to $2,000, right, in ending retained earnings. Next month, if we did the exact same thing, we'd start with $2,000 in beginning retained earnings, add $2,000, subtract $1,000 in dividends, so the ending balance at the end of month 3 would be $3,000. You with me? You see how that's working? So this ending is going to be next month's beginning. or next year's beginning. Okay. All right, so now notice what happens is that $1,000 right there that we just calculated now gets pulled into the balance sheet right here, right down here at the bottom in the stockholders' equity area. Okay, so you see why those have to be done in that order, right? We have to calculate net income because we need that net income number in the statement of retained earnings. That ending retained earnings needs to be pulled over into the balance sheet. So they're tied together. So do you see, again, I sort of warned you about this earlier. If you've got a mistake in your income statement, that's going to pull through to your retained earnings statement, which is going to pull through to your balance sheet. So I'm going to tell you, the one thing y'all are going to hate about this is slower is sometimes faster. Okay? Because you're not going to know that you've got an error until you get to your balance sheet. Okay? So watch what happens here. All right? So in this one, now notice the top. Still still name of the company. Title of the financial statement, but look at the date. Now it says at. Okay? Because a balance sheet is printed on a very specific date, and there's even an implied time up there because that is end of working day on September 30th. Bam, that's what the balances looked like. Because the very next day on October 1, if we write a check to somebody for whatever it might be, at least cash is changing. You see that? So that next transaction changes the balance sheet. Okay? How we doing? All right. So now notice what happens here. All right. So now we've got assets equal liabilities plus stockholders' equity. All right. Now notice what's up here under the assets, right? All these things have value. So we're listing them out. But what order are they in? Unless you did your reading, you're not going to get this one. They are in order of what we call, you want to give it a shot? Oh, beautiful. Liquidity, which means how close are they to turning back into cash? So cash is already cash. Accounts receivable, that is sales that we made in previous periods to customers, but they haven't paid us yet. And again, that's usually 30, 60, 90 days. Supplies, usually we're using those up in a few months. Equipment, those could go on for years of using those. Software, again, we're going to be using software for years, right? So you can see that it's like that's kind of the order in which we put those. Good. All right. Liabilities. Okay, in this case, we only have two. We've got the accounts payable, so that's what we owe somebody that we bought something from. And then we've got the notes payable, which is due to probably a bank or someone that we borrowed money from, right? So in this one, what order are they in? Liquidity. Okay, so they are also in order of liquidity because the accounts payable is going to be due within 30, 60, 90 days. But this notes payable is probably due over the course of a number of years. Okay? How are we doing? Again, single line above, single line below indicates a subtotal. Notice up here under the assets, that's a single line above and a double underline below, which means a grand total. Okay? Then we've got our stockholders' equity. So we had issued stock for $10,000, and there's our calculated retained earnings for $1,000. Okay, so again, we get a subtotal for total stockholders' equity. We add the $25,000 and the $11,000 to get to $36,000. So notice what happens here. The balance sheet, $36,000 in assets, $36,000 in liabilities and equity. So think about how that happens. If you had a mistake in your income statement, it would be reflected right here in that retained earnings. But when you pulled all these numbers in, your balance sheet wouldn't balance. So that's a big part of the issue why slower is sometimes better and faster, because you could, you pull this in, now you don't balance and you're like, oh man, what went wrong? Okay. I'll give you some tips on how to find errors, so fear not. How we doing? Okay. All right, now, again, remember that fourth financial statement? Now, remember we had $13,000 in cash on that balance sheet? That's the number at the bottom, okay? So, when I'm putting together cash flow statements, and again, in accounting overall, sometimes you just got to grab the low-hanging fruit, okay? Because we know that because that balance sheet balanced, we know that $13,000 in cash should be correct, okay? So that's going to be our ending balance down here at the bottom. We're going to start with how much we had to start with. This company is brand new, so we had no cash to start with. So we know that the change had to be $13,000 between 0 and 13. So now we've got all three of those items down there at the bottom. Now we've got that nailed down. We know that it has to be 13 of the change. Now let's prove the change. So in the change, we are going to break it out between three different groups. We've got operating activities, which think operations, which sounds like which financial statement? Operations. Kind of sounds like the income statement, doesn't it? We're earning revenues, we're incurring expenses, right? So everything that is up here under operating activities is revenues collected and expenses paid. Okay? Now, the important thing to understand the difference between an income statement and a cash flow statement is the cash flow statement, we're talking about how much did we collect from the customers. In the income statement, we're showing how much did we earn from customers. So we could have earned something this period, but not collected it. Does that make sense? So we could have earned revenues that showed up on the income statement, but we could have possibly had 0 collections from customers because we didn't actually collect anything. Okay, so make sure you're clear on what's showing up on which statement. Okay, all right. So there's the operations. We collected $9,500 of revenues and we paid out $5,500 in expenses. Okay. So in this particular case, we've got a net cash increase of $4,000 on operating activities. Okay. Second group, we've got investing activities. Now, investing activities, let's be clear on this one. We are investing in long-term assets. So we're over here on the asset side of the balance sheet, and we are effectively either taking cash and turning it into a long-term asset, or we're selling that long-term asset and turning it back into cash. You with me? Okay. So in this particular case, we used $20,000 to buy equipment and software. So we took cash out of the bank, turned it into a long-term asset. Okay. All right. Then we've got financing activities. Now under financing activities, think more along the lines of who are we paying? So financing activities are money's principal payments of loans back and forth from the bank. So if we take out a loan, we've got a cash increase. If we pay back the principal of a loan, we've got a cash decrease in financing activities. You with me? Okay. Now, be careful though, interest is actually reflected up here on the income statement. So any interest payments to the bank would be up here, not down here. This is only principal. Okay. So we've got money back and forth to the bank on principals of the loans, and we've got money going back and forth from stockholders. So either we're issuing stock and money's coming in, Or we could be buying back stock and money's going out, but stock is coming in. Or we're paying dividends. How we doing? So again, here on financing activities, it's money back and forth to the bank. It's money back and forth to the shareholders. Okay? So in this one, here's the cash that we received when we issued the stock. So we gave them stock, or you, maybe I'm one of the investors, you gave me stock, I gave you cash, right? Okay? Then cash dividends. So now you said, hey, thanks so much for that $10,000. Here's a little something in return. Okay, so you paid me $1,000. And then you actually went to the bank and borrowed $20,000. And again, that's principal. Yes. A dividend would be more along the lines of, I gave you $10,000 to start with, right? So I gave you 10, you gave me stock, and then maybe 6 months later, a year later, you're like, hey, you know, we did pretty good this year and everything. We want to say thank you to the shareholders. Because again, remember, if I don't get some kind of return on my money, I'm not going to invest with you anymore. So let me give you, let's do a little time warp here. Back in the 1990s, when Microsoft was just growing like crazy, Microsoft didn't pay a dime in dividends. Any thoughts on how they could get away with that? They grew the business, so my shareholder stock price is going up. So Microsoft in the 1990s, Microsoft's stock price was like 20% per year. Okay? And all the shareholders were like, yeah, we're good. You keep that money. We're happy with our returns. You just do what you need to do. That's the reason why Microsoft has like billions and billions and billions of dollars of cash. But once that just explosive growth sort of ended, at that point, maybe they're going back to 10% per year, but now the stockholders are used to 20, and they're like, gonna need a few dividends here, folks. Okay, and Microsoft had to start paying dividends, which they hadn't done for a long time. Okay. How we doing there? Cash flow statement. Okay. All right. Then we've got the notes to the financial statements. Now, keep in mind that the notes to the financial statements, I've got y'all until, what, 12:10? Yeah, 12:10. All right, so notes to the financial statements. One of the things to keep in mind is this. The notes to the financial statements, you cannot really interpret the numbers correctly unless you have the notes to the financial statements. Okay? Now, how many of you have taken Business 110? Okay. I guarantee you they never mentioned notes to the financial statements. I knew it. I have to give them a hard time about that all the time. So the first note to the financial statement is called significant accounting policies. So unless you know what the accounting policies are, we're going to go through this semester and you're going to learn that there's different ways, and all of them are legit. There's different ways to value inventory. There's different ways to depreciate assets, which is going to have a big difference on how much you're showing on your balance sheet. And if we don't know what those policies are, then we don't really understand what the numbers are. Okay? And just keep in mind that when you're looking at a set of financial statements, the numbers, the four financial statements, even in a very large organization like a Walmart or something, you might be looking at 4 to maybe 5 pages of numbers. And you might be looking at 60 pages of notes to the financial statements. So if they give you 4 pages of notes and 60 pages of, 4 pages of financial statements and 60 pages of notes, you think the notes are important? Because they're telling you that you can't interpret those numbers without those 60 pages of notes. Okay? So make sure that you're clear on that. We'll just depends on how much time we got. We might pull up some set of financial statements. All right? So again, little review, right? The first statement is the income statement. We ended up with $2,000 in net income. We pulled that $2,000 of net income into the statement of retained earnings. We then calculated the ending retained earnings, and we pulled that ending retained earnings over here to the balance sheet. We pulled in all of our assets, our liabilities, and our common stock, and our balance sheet balance. Now, in a perfect world, that's how that works. But again, just be careful. All right, then we proved that cash balance of $13,000 with that statement of cash flows. So now when we're sitting here looking at that statement of cash flows, we can look at it and go, okay, we brought in $4,000 from operating activities. Well, that's good. That means we're collecting more than we're paying out in operations, revenues, and expenses. On the investing activities, we can see that we invested in some other long-term asset. And then here from the financing activities, $29,000 came in from financing activities. So where did most of the money come from? Financing activities, where we issued stock and borrowed. We don't want that going on a long-term basis. But again, this is a brand new company and we're just getting started. That's kind of normal. How we doing? Okay. All right. So how are financial statements used by decision makers? All right. You got a couple of different kinds of decision makers. One, you got creditors. That's people that we are buying from or borrowing from. So one of the questions that they want to know is the company generating enough cash to pay what it owes? Well, if we want to look at details on cash, which financial statement is that? The cash flow statement. Okay. Another question that a creditor might want to know is, does the company have enough assets to cover its liabilities? Well, where do you see assets and liabilities? The balance sheet. Now, that's kind of a worst case scenario. Like if the company went out of business, could we liquidate the assets to cover the liabilities? Okay. Investors, remember, there's 2 ways for us to get money back as investors. So what's the immediate return through dividends on their contribution? So where do we see dividends? The retained earnings statement, good. And what's the long-term return? Through stock price increases resulting from company profits. Where do we see company profits? Income statement. Okay? So everybody might have, just depending on what we want to learn, we might focus in on a slightly different set of financial statements, but we still have to look at them all together. All right? So useful financial information. All right? Couple of things to note. One, and I'm going to dispel this rumor. Okay? I don't mean to offend anybody, but everybody always gives the U.S. crap about our accounting standards. Y'all are the only ones that use them. Okay, that's fine. And then they say, but everybody else uses international standards. Not really. International standards are so flexible that they can be implemented in all kinds of different ways in every single country that accepts them. There's even countries that have no sets of financial, accounting standards, so that whoever the new regime is, that's coming in, it's like if they want to do things differently, things get done differently. The next regime comes in, they want to change something, it changes. Okay? So just realize when they say international standards and they want to act like it's all one thing, it's not. It's all different, and depending on what country you're in. Okay. So this is International Accounting Standards Board. They are the ones that make up International Financial Reporting Standards. Okay. Then you've got the Financial Accounting Standards Board. It comes up with generally accepted accounting principles. Okay. So let me just say, overall, in the U.S., our standards are much more conservative here than international standards are. Okay. Now, I promise you, it's like I don't think that I am just a genius or anything else. But we attempted to bring these two sets of standards together for decades. And they kept saying, it's going to work, it's going to work, it's going to work. And honestly, I kept sitting there going, no, it's not, no, it's not, no, it's not. Because, and make a note of this one because we'll come back to this in chapters 5 and 6. One issue threw everything, a wrench into everything. So all it takes is one issue and these don't work together. And that's inventory. So when we get to chapters 5 and 6, we'll talk about inventory and why this didn't work. Okay? All right? Now, what kinds of overarching things are we looking for on a set of financial statements? One, it has to be useful information. We don't want a bunch of mess on there. Two, it needs to be relevant. Because if it's irrelevant, why put it on there? Okay? It needs to be a faithful representation, which basically means that we should be pretty close. Now, in accounting, the one thing that kind of drives you all crazy, because y'all think that we accountants are just like sticklers for everything, is like, no, we use a lot of estimates in accounting. So it's not all about tying everything out to the penny. That's not where we are. A lot of people think we are, but we're not. But it needs to be a faithful representation. Okay? It needs to be timely. So let's say that your year end was December of 24. We're going to give you until about the middle of March of 2025 to get those financial statements wrapped up and published. Okay? We're not going to let you go years without publishing this financial statements. It should, the numbers should be verifiable, which means multiple people should be able to come in, look at your work, and reproduce the same thing. Okay? They should be comparable. So, keep in mind, and this is where this is a lot deeper than you probably think. So, when we're looking at a set of financial statements, and we're talking about this comparability, the big thing is that you want to be able to take two sets of financial statements, sit them next to each other, and be able to determine which company is doing better, okay? But there's a lot of other things that go into that. Number one, these two sets of financial statements really need to be from two companies that are working within the same industry. You with me? So it's not like we could take a Walmart and compare it to a shoe store that only sells shoes, right? Those are two different areas of the economy in which they exist, okay? So trying to put those two sets of financial statements together, that's going to be for naught, okay? The other thing is we can't take a Walmart set of financial statements and compare it to a mom and pop store set of financial statements, even if they run some kind of like little mini version of a Walmart. You with me? Because you've got a huge company comparing it to a really tiny company. So when you're comparing financial statements, it needs to be in the same industry, should be for the same years, same time periods, and it needs to be the same size company. Okay? So you're going to thank me on that one if you remember that in your strategy class when you get to your senior year. Okay? So comparability is big. And then they have to be understandable. Now, understand this, though. about this concept. It does not mean that any person off the street should be able to completely analyze a set of financial statements. It means that the set of financial statements are understandable to someone who has the proper training to understand them. Okay? How are we doing? All right, so all these things kind of come into play when we're trying to put these together. Now, ethical conduct. Now, I'm just going to tell you, I don't mean to scare you or anything else. In accounting, if you go into that career path, this is not an if, this is a when. It will come at you from all kinds of different directions. It could, so when we're talking about ethics, just realize we're talking about ethics. We're not talking about morals, okay? Ethics is the thing that has been right since the dawn of time. Morals are location and time sensitive, okay? Depending on where you go, where you are, what year it was, all that kind of stuff. So we're talking about ethics. And one of the things that you have to realize is that it's things like this. They didn't really, I don't think they really thought this one through, but at one point, a number of years ago, Congress said, okay, with these public companies, you know, the CEO can't make more than X number of times the lowest paid person within the company. Okay? And, you know, they thought, that'll fix it. The first thing that happened was the lowest paid people in the company, guess what, got outsourced. So now they don't work for the company itself. They work for an outsourcing company. So then now that brought the lowest paid person's salary up. You with me? And then they did that as much as they possibly could. So then now the CEO can't make more than X times those folks. So then they sat there and went, okay, so the CEO can't make more than, you know, X times that person. So how do we compensate them to do that? Well, the next thing they did was they started issuing stock to the CEO. So now the CEO has a big stake in what are the financial statements looking like. Okay? And sometimes, just depending on what kind of company it is, how big they are, and all that kind of stuff and everything, sometimes the CEO is not the person that really grew up, if you want to call it that, grew up in the finance and accounting area. They're usually coming through marketing and sales. And you know how many accounting classes those folks in marketing and sales have had? 2. Because their focus when they were in school was marketing and sales. They took a ton of marketing classes and, you know, all of the strategy and everything else, but they're not focused on the accounting and finance side of it. Okay? So now it's like when, and even middle management even usually has some kind of stock bonus plan tied to their salary as well. So now they're sitting there and everybody's got stock in the company, and now they're like, oh, wait a minute, we're only $500 away, and this is a tiny thing, but we're only X number of dollars away from meeting that goal, that if we met that goal, it's like we get an extra bump in salary or stock bonus or whatever it might be. You with me? So then what's everybody's motivation? Let's figure out how to get that extra little piece up. And all the accountants are going, we've already done our best and that's the result. But do you think that they get pressured to do more? They do. And most of the time, a lot of times, the answer is, or what they say is, it's like, Well, what's it going to hurt? Well, okay. So when you're in accounting, let me just say that it's like a lot of times you're going to have to build a pretty thick skin. The other thing is you have to take care of your personal finances really well, because you may run into a point where when somebody won't let up, your only option is to leave. Okay? So let me just tell you, at one point my husband got some serious pressure. I told you he's a CFO. Got some serious pressure from a CEO one time, and my husband was like, no, 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 no. And at one point the CEO looked at him and said, well, you may not have a choice. And I got to tell you, my husband didn't tell me about this for years afterwards. I wish he had told me that day, because we would have gone out to eat that night or something to celebrate. But my husband looked at that guy and said, I always have a choice. And let me tell you, that is one of the days in my life that was worth every choice that we made to maybe not go do something or save a little bit extra money or whatever it might be. Because he wasn't at the hands of the CEO. It's like, oh no, I don't think you understand how this works. Okay? Oh, I know. Let me just tell you, that's one of those things where it's like, y'all, the big cars, the big house that you got to go into debt up to your eyeballs for is not going to be worth it after about 6 weeks. You're going to love it for about 6 weeks. That's it. So go on some home tours. Enjoy the architecture. Look at the big houses and everything, and then go back to your small house that's paid for, your cars are paid for, and you probably are worth more than the person who has the big house, the big car, and everything else, because they're in debt up to their eyeballs. Okay? That's my personal finance class, so come on over and you want to learn more on that one. All right, so public companies. Let's see, what do we got here? Got about 2 minutes. Let's see. Public companies, I think we've just already really talked about most of this. Data visualization. If you find that accounting is your thing and you like technology, data analytics, folks, all day long. Okay. I'm not going to stop here. Let's see. Because there we go. All right. So what I want to do is open up your computer, open up a new screen, type in Lowe's.com. We're not going to go shopping. Okay? Now, where can you find the financial statements for Lowe's? Good. You go all the way down here to the bottom, and pretty much, well, they may have hid it from us again. Oh, God. They drive me crazy when they do all this. They move everything around, and then you're like, oh, great. We got a new set of things here. Let's see. It used to be at the bottom. All right, hang on.